Hello everyone, today I'm going to be talking about bond valuations in a specific case. So for this specific case, I will look at two bonds, bond A and bond B, that have the same par values, coupon rates, and credit ratings. And I will examine the variables that affect bond market prices and how responsive they are to interest rate fluctuations. And then I will also discuss bond investors' response to the state of the economy through investment techniques. And then I will also examine the dynamics of bond markets and investing choices in the context of changing market circumstances and bond attributes as well. So let's take a look at which bond would it be more beneficial to choose if interest rates would go up. So in this case, bond A has a 30-year maturity, bond B has a 5-year maturity, and will trade at a premium as a result of that. And then bond prices and time to maturity have an inverse relationship, which is very important to understand. So whenever interest rates go up, the initial bond prices go down. And so in this case, shorter maturities lower the risk associated with interest rates, which attracts more investors due to those reasons that I've just explained to you. And then consequently, the shorter maturity of bond B raises its market price, and therefore it becomes more appealing for investors in a volatile market. Let's take a look at the impact of interest rates on bond A versus bond B. In this case, the market values of bond A and bond B will both decline as interest rates rise. And this is due to the fact that freshly issued bonds with higher coupon rates become more appealing than currently outstanding bonds. And as interest rates rise, the present value of future cash flows from outstanding bonds declines, which lowers the bond prices. And as, for example, as you can see on the picture to the right, you can see that if we started with 3%, but then it increases to 4% while after you've already purchased your bond, then you're basically pretty much losing that 1% every year that you've been having that specific bond. And eventually this could be seen as a loss for you. But if the interest rates go down, you're the one at the benefit because you're going to be receiving with your current interest rate a higher percentage and yield at the end of the year. Let's continue looking at that case as well. So in this example, bond A's price will move up more than bond B's due to its longer period to maturity. And in this case, we're talking specifically of increased interest rate in a specific year and how would it impact both of those bonds. And for long-term bonds, they're more susceptible to fluctuations in interest rates due to the length concept. And then in comparison to bond B, bond A's longer term causes a bigger percentage price change for a given change in interest rates. So basically what the length concept is specifically referring to is that the longer the bond maturity date is, the more affected it gets by the increased interest rate, because that interest rate is continuously applied over those years. And then let's take a look at specific examples for this case. So hypothetically speaking, if simple rates rise up by 1% from 10% to 11% in the next year, after purchasing that specific bond, bond A's price may drop by 30%, but bond B's price may only decline by 5%. If both bond A and bond B have the same credit rating, a par value of 1,000, and a coupon rate of 10% initially at the start. And so this demonstrates how bond A's longer maturity date makes it more sensitive to fluctuations in interest rate. And this is regarding specifically the simple interest rates. But now take a look at some more complicated ones, which is the compound interest rate. In this case, if its interest rate rises by 1% from 10 to 11, bond A's price will drop by 8.6%, but bond B's price will only drop by 3.7%. If we have both bond A and bond B in the same credit rating, par value of 1,000 and a coupon rate of 10%. So in this case, you can see due to those, by looking at those calculations for bond A and bond B, you can see that within bond A, as it had a longer maturity date, it is losing more every single year by not having this increased interest rate that the other bond B, for example, once the maturity date comes close in 5 years, they would be able to reinvest into that with an interest rate which is more appealing to them. And for example, that interest rate that was increased by 1%, after 5 years, bond B already is going to be sold. And so the specific investor would be able to reinvest that money at a higher interest rate, while the person who invested in bond A will still be stuck within that specific situation where they couldn't sell it. And then even though the interest rates are still higher than the ones that they've purchased the bonds for, so they're losing in terms of that specific case. And now let's take a look at what happens if the economy slows down over the next 12 months and how would the investors react to that. So the investing strategy would be to move towards shorter term bonds or lesser duration bonds funds in anticipation of an economic decline, so that you are less susceptible to the interest rate fluctuations. And then bonds with shorter maturity period exhibit lower interest rates, volatility, and provide greater flexibility for future reinvestments at higher rates, as just mentioned. And then during the times of economic instability, putting a portion of the portfolio in treasury securities or high quality bonds can offer stability and protection. And it would also allow you to diversify your portfolio, keeping your investments safe, secured, and also allow you to invest your remaining resources into more volatile bonds and investment opportunities that are going to provide you with higher yield. And that way you're going to be able to protect yourself and at the same time moderate your risks when it comes to investments. And yes, thank you for listening to this presentation. Here are my references. I will see you soon and goodbye.